While being slightly fast-paced, as of this moment in live trading, AMC Entertainment Holdings, trading under the ticker symbol AMC, is priced at $2.88, reflecting an intraday gain of 1.58%. The stock has fluctuated today between a low of $2.83 and a high of $3.08 on a significant volume of over 21 million shares. Now, the common expectation is to frame this movement within the persistent meme stock narrative, a simplistic tug-of-war between retail investors and institutional shorts. However, the reality of today's market action is far more nuanced and deeply rooted in a complex financial recalibration that the headline chasers are largely ignoring. While social media platforms may still be buzzing with old battle cries, the sophisticated money, whether through Fidelity Wealth Management or Interactive Brokers, is dissecting something far more critical: the tangible success of AMC's recent debt refinancing and its direct implications for operational runway and future cash flow. The expectation of pure sentiment-driven volatility is being met with the harsh reality of balance sheet mechanics. This isn't just a game of who can hold the longest, it's an intricate dance of debt maturity, interest expense reduction, and the fundamental question of whether a recovering box office can translate into sustainable corporate health before the capital markets lose their patience. The recent trading patterns in AMC stock tell a story of nervous energy. We're seeing significant intraday swings, not just today but over the past several weeks. The stock has been wrestling with key technical levels, finding it difficult to build sustained momentum above the $3 mark, which appears to be a psychological resistance point. The trading volume, while substantial, is lower than the explosive levels seen during peak frenzy periods, suggesting a different class of trader is now influencing the price. This isn't the chaotic, high-frequency activity driven by retail traders using platforms like the Robinhood app that we saw in 2021. Instead, the current volume suggests more methodical entries and exits, possibly from smaller hedge funds and family offices adjusting their positions based on macroeconomic data and sector-specific news. There's a palpable tension in the air. On one hand, any positive news about a blockbuster opening weekend can cause a sharp, aggressive spike. On the other, fears of continued shareholder dilution or a weaker-than-expected film slate can trigger equally abrupt sell-offs. This volatility is a playground for day traders, but a nightmare for anyone attempting traditional self-investing without a high tolerance for risk. The short interest remains a key factor, sitting near 10% of the float. This is still a considerable figure and ensures that the possibility of a short squeeze is never entirely off the table, keeping a speculative floor under the price. However, the cost to borrow shares has stabilized, indicating that the institutional short sellers are not in the same state of panic they once were. They are now placing calculated bets against the company's fundamental ability to service its massive debt load in a high interest rate environment, a far cry from the narrative of an all-out war. The core of the AMC story, the ultimate arbiter between expectation and reality, lies in its financials. The market expects a binary outcome, either a spectacular return to glory or a swift spiral into bankruptcy. The reality is a grueling, slow-motion battle for solvency. The company's successful refinancing efforts earlier this year was a masterstroke of financial engineering, pushing significant debt maturities from 2026 out to 2029 and beyond. This move, which involved raising approximately $244 million in new financing, was not just about kicking the can down the road, it was about buying time. Time for the domestic box office to fully recover, time for new revenue streams like branded popcorn and merchandise to mature, and time to optimize their theater footprint for profitability. However, this came at a cost, including higher interest rates on the new notes, which will continue to eat into cash flow. While the most recent earnings reports have shown improvement, beating analyst expectations on both earnings per share and revenue, the company is still not consistently profitable. The bulls, perhaps those making aggressive trades on the SoFi trading platform, point to rising attendance figures and record-breaking per-patron spending on concessions as proof of a turnaround. The bears, however, point to the colossal $8.27 billion in debt, a figure that dwarfs the company's entire $1.49 billion market capitalization. This debt reality means that even as revenues climb, a huge portion of that income is immediately diverted to service interest payments, severely limiting funds for reinvestment or a return of capital to shareholders. It creates a situation where the company must run twice as fast just to stay in the same place. This fundamental disconnect is why institutional investors, those managing Fidelity mutual funds or constructing diverse portfolios through Schwab Intelligent Portfolios, remain overwhelmingly cautious, with the consensus analyst rating hovering at a hold. For those new to the saga, AMC Entertainment Holdings is the largest movie theater chain in the world, operating thousands of screens across the United States and Europe. Its business model is straightforward. It generates revenue primarily from ticket sales, box office receipts, and secondarily, but with much higher margins, from the sale of food and beverages, concessions. The company's history stretches back over a century, but its modern story is defined by two cataclysmic events: the COVID-19 pandemic, which forced a global shutdown of its theaters and pushed it to the brink of bankruptcy, and the subsequent meme stock phenomenon, where a legion of retail investors coordinating on social media drove its stock price to astronomical heights, allowing the company to raise life-saving capital by selling shares at inflated prices. This history is crucial because it created the expectation that AMC is more than a company, it's a movement, a cause. The reality is that while that capital infusion saved it from immediate collapse, it also led to massive shareholder dilution. The number of outstanding shares has ballooned, meaning that the proverbial pie has been sliced into many more pieces. So, for the stock price to reach its former heights, the company's overall valuation would need to be multiples of what it was even during its most profitable pre-pandemic years, a staggering challenge. Thinking about broader investment strategies, one has to compare the high-risk, high-reward nature of an individual stock like this, AMC stock, with the more stable growth trajectories of giants like Apple stock or the explosive sector-defining performance of Nvidia stock. For many, the wiser path for online investing involves diversified instruments like Fidelity ETFs rather than concentrating capital in such a volatile name. Looking toward the future, the outlook for AMC is a tightrope walk over a financial canyon. The primary catalyst for a sustained upward move in the stock is undoubtedly the film slate. The box office is the engine that drives everything. A string of unexpected mega hits could rapidly change the narrative, generating the free cash flow needed to start paying down debt principal, not just servicing the interest. The company is also aggressively expanding its footprint of premium large format screens, which command higher ticket prices and are a key differentiator against at-home streaming. Success in these initiatives, combined with continued growth in high-margin concessions and alternative content like live sporting events and concerts, represents the most plausible bullish scenario. However, the risks are equally formidable. The biggest is a potential economic downturn that curbs consumer discretionary spending. Movie tickets are a luxury, and in a recession, households will cut back. Furthermore, the ever-present threat of streaming services continues to loom. While the Barbenheimer phenomenon proved that cinematic events can still draw massive crowds, the overall consistency of moviegoing habits has not returned to pre-pandemic levels. Another significant risk is the potential for further share offerings. With a massive debt load still on the books, management may be tempted or even forced to sell more stock to raise cash, further diluting existing shareholders. For anyone considering an online investment in AMC, whether through an individual brokerage account with Fidelity or a more modern platform like SoFi Invest, these factors must be weighed carefully. Comment below with your thoughts. Do you believe the upcoming holiday movie slate has what it takes to significantly boost AMC's fourth quarter earnings? In summary, the story of AMC stock in late 2025 is a departure from its sensationalized past. The expectation of a simple retail versus hedge fund battle has given way to the complex reality of corporate finance and operational execution. Today's 1.58% gain to $2.88 is less about memes and more about the market's minute-by-minute reevaluation of the company's progress in its fight for survival. The successful debt refinancing bought crucial time, shifting the focus from immediate bankruptcy risk to long-term operational performance. The reality is that the path forward is fraught with peril, from macroeconomic headwinds to a colossal debt burden that will shadow the company for years. The ultimate outcome will depend not on social media sentiment, but on the cold, hard numbers of box office receipts and the management's ability to navigate a treacherous financial landscape. The expectation was a sprint, the reality is a marathon, and the finish line is still nowhere in sight.